So we have two great panels to end the day. Really looking forward to both. From JOLCO to Bilaterals to Bareboats, finding the right fit for lenders and borrowers. We have just a great group of super active market participants, and they'll be led by John Benson, partner at Watson, Farley, and Williams. Thanks. Hey, Andy.
Good? Good. For those of you I don't know, my name's John Benson. I'm a partner in the asset finance group at Watson Farley. Just real briefly, I know we're not supposed to do introductions, but I just want to go down the line. Joined by Andy Longhurst, CSG Investments, Harris Antoniou, Neptune Maritime Leasing, Ben Lmadani, ABL Corporation, and Evan Cohen, First Citizens Bank. So I began in this practice 20 years ago, and I mention that only for context, because at that time, it was term loans. Mortgage-backed term loans were the order of the day, and as a newly minted associate, you saw 1 or 2 term sheets a month, and maybe the covenants changed, but the security packages were generally the same, and it was probably the best education you could get. And then 4 or 5 years later, we got to revisit our work in 2008, so we moved on from there. The environment today is radically different. Owners have more options than ever. So that brings us to the panel, and I just want to regurgitate sort of how it was described. Finding the right fit for lenders and borrowers, whether it's a specific structure, asset type, age, or deal size, lenders who are able to develop a niche can offer borrowers superior execution, repeat business, better terms, structural advantages, and a faster speed to closing. So maybe we start there.
Say it again. Yeah,
Maybe hold the mic a bit closer.
You can.
just say it a bit louder, John. We didn't hear the
The
sounds
prompt.
like someone's brochure. I don't know what you were saying.
It's the Marine Money brochure. So let's just jump in from there. Why don't we go down the line, and starting with you, Evan, maybe you can tell us what structures you look for, and is there an asset type, age, or deal size that you're looking for when you're assessing a structure?
Oh, what structures do we look for? Oh,
Very top down.
go back to your 30 years
20.
you started.
20.
We want the plain vanilla
Yeah.
senior debt, and we're going to keep the loan agreement. Hopefully there's no 2008 to make us look at the loan agreement again. No, very straightforward senior loan. The sanctions language changes and evolves over time. We have the same debates over advance ratio and margins, and that's just
It's not the 90% from it's not the 90% ratio from 2003, is it?
No, that's why you have Harris on the panel here.
Exactly. Andy, maybe over to you.
Yes, I echo what Evan said. We're a very vanilla shop. We like term loans. In fact, that's all we do. We provide term loans, whatever the asset class we're looking at, whether it's real estate, oil and gas, or shipping. It's a very simple organization and very simple structure. When I think about what niche do we provide, I think what we do, which is probably somewhat different from most lenders into the industry, is that we want to provide capital when others are unable or unwilling to do it. And when other lenders are willing and able to do it, we're frankly not interested. We're not price competitive. I think the classic examples of that right now are, our ethos is to try and lend at or close to the bottom of the market. And, we did tankers in 2018. We did containers in 2019. We did Jones Act last year when, there weren't really a huge raft of lenders available to do it. And this year we're doing drill ships. And again, the key component in all of those areas is those are sectors where other lenders do not really want to play at the moment. So that's our niche, I think.
Harris, can you tell us about your business?
Yeah, sure. It's because of this 30-year experience that we have accumulated that we decided to go into leasing, in fact. Although we've been bankers for the best part of our careers. We set up Neptune Maritime Leasing 3 years ago to, in fact, support the industry with capital in what seemed to be a dislocation in terms of the availability of funding versus the demand. Of course, times have moved on. There's more availability now, but nevertheless, we still have a very constant flow of business. You know, our pipeline is sort of $1.5 billion at any given point in time as we go through different projects. And we've decided to do leasing simply because we thought that it offers the best risk-reward ratio compared to what we've seen in the business. It's a flexible type of finance. It is providing a match to the maturity of the asset. So that means that we're able actually to provide longer profiles versus what a normal bank would do. So we match the profile of the asset. And of course, we're able to do that at very competitive terms, also because we set up as a company and not as a fund. And that means we have a balance sheet. We are able to use that balance sheet, you know, to attract better funding, higher quality funding from our lenders. And as a result, being able to offer a much more competitive product, predictable and fast product to our clients.
What can you tell us about your business? What are the structures you're looking for?
Come again?
What can you tell us about the structures you're looking in?
Well, thank you very much for having us. We, as ABL, we are specialized in aviation, and we are moving from aviation to shipping. We have a fleet, as you said, on leasing. I think in shipping, there's not enough lessors. So the idea that as a lessor and a finance lessor and operating lessor in aviation with a fleet of $5.5 billion, we see more and more of our investors asking to have the same model as we did in aviation into shipping, either in finance lease, operating lease. We entered into a joint venture with AMA Capital that we really like as partners. That joint venture allows us to deploy the capital that we have either from Japan or Middle East that we deployed in aviation and to have exactly the same in shipping. You have a lot of leasing structure that we apply into aviation that are just starting to come into shipping. They are quite innovative structure, 100% financing. It can be either tax depreciation financing or basic finance leases. And I think that there's a big need, as you said, on leasing in the shipping, and that's what we're starting to develop little by little in shipping.
So with backing up, we'll get back to senior lending. You know, the velocity of prepayments in the market now is unprecedented. Maybe over to you, Evan. How are you dealing with that as a bank, and how are you seeking opportunities in that environment?
We look for portfolios to buy, and sometimes we come in second place, which we did with the NIBC book, so congratulations to Hamburg Commercial Bank. And congratulations to NIBC team that put together a very nice business. I'm sorry to see them go, but you have to look for bigger tickets. So for our good clients, we'll take more exposure, and we will look for portfolios. And for context, if anybody's not following it, the normal repayment rate you will get on a bank loan, if you're on the banking side, is you'll get 30%, maybe 35% of your money back every year. We've had 55% of our money coming back every year for the past couple of years. So in 2 years, you're getting your book back and you have to put it back in there. So you look for opportunities like the recent NIBC portfolio.
Andy, has your business been affected by the repayment velocity in the current market?
Not really, and I will echo again what Evan said about the NIBC portfolio, and I think it's fair to say that we came last in the bidding for that process. Now, in terms of prepayments, we are not a normal bank. We are a normal bank in that we're regulated, but we're privately owned, and because we put our money to work when other people don't want to, we totally understand that when the market comes back, people want to give us our money back because it isn't the cheapest. We do protect ourselves with a kind of 3-year make-whole structure, so we know we're always going to make about 3 years of interest. And that's totally fine by us from a return basis. You know, we generally get about 20% return on most of our deals. We try and always make at least $20 million on a particular transaction. And that's all we need to do. I mean, we're very lightly resourced, so we're not expensive to run. You know, my cost-income ratio in shipping is probably less than 5%. So we can afford to, you know, get those prepayments, sit on our hands and not do anything until the market froth goes away again.
And you had mentioned ticket size, do you think your ability to write a big ticket and reliably so differentiates you from the market right now?
Yeah, I would say it's a super strength, actually. You know, we can't do small deals, unfortunately, because I see a lot of small deals that are otherwise attractive. But for us, because we need to make, you know, 20 million bucks on a deal, we really can't transact much below 50 million ticket sizes. But the flip side of that coin is we go up to about $800 million, and that's a number that we're prepared to take and keep on our balance sheet, and we've done that in the past, and we'll do that again.
Interesting. Harris, turning to the leasing side, in a market where owners are historically flush with cash, low debt ratios, historical, how do you source opportunities in this market?
A lot of it is direct sourcing, but you know, going back to the availability of funding, I mean, absolutely true. There's a lot of cash generated over the past couple of years. Of course, we only set up the company 3 years ago, so and we have experienced rampant growth, in particular in the last 12 months, where we quintupled up a portfolio. Of course, it's easier when you start from a smaller base, but nevertheless, we have seen no issue with prepayments or repayments, not yet. We've seen growth, and one particular differentiating factor for us is that we're not focusing on mega deals. Neither do we focus on, you know, super sort of small deals. We're happy to help our clients, you know, across the capital structure and in the size they need, actually. So we're happy to do a single vessel deal that is $10, $12, $50 million. We're happy to do a $150 million deal. And that is actually a very powerful tool in the sense that we have been able to do repeat deals with customers. So we have the blueprint. You know, we do a small deal of 10, 15 million, and then it's just repeat deals one after the other. So we've been able to grow our portfolio without focusing on, you know, very large transactions, but focusing on actually helping our clients grow the business. That's number one. Number two is because we've been in the industry for many years, we have direct relationships with many, many clients around the world. We have a geographical footprint that allows us to source deals, you know, across the globe practically, with offices and representation in Norway, in the Netherlands, in Switzerland, in Athens, covering also the Middle East, but also recently set up shop in Singapore, covering the Asian market. So we're able to source deals directly. And the third and last point I wanted to make is that there is no shortage of deals. You know, there's tremendous second-hand market, which has developed over the past few years. And then we saw a revitalization of the new building market as well. And if you look at what we've observed over the past few years, in particular between 2020 and 2024, you've seen the size of the order book double in certain cases. Like if you look at dry bulk, if you look at tankers, even, you know, a much higher percentage growth. So that growth allows both banks, the leasing companies, and other funds, other market participants to be out and growing the business. So I think it's a very positive, you know, background to expand our business.
Interesting. So, Ali, maybe I can ask you and pick your brain, given your experience in aviation. So leasing structures have increased in popularity greatly over the last, you know, decade, but they're still nowhere near the percentage they are in a market like aviation in shipping. Why do you think that is, and do you think there's still more ground to gain?
Well, we were able, as you said, leasing is new to shipping, and congratulations for setting up a leasing platform in shipping. But in aviation, we got to 5.5 billion by making sure that we are very innovative in our structure. You cannot just go and be a bank and deploy the money. You know, it's 100% financing. You have to be very innovative, and that's the idea that we're starting right now in shipping, to have exactly the same kind of innovative structure. At the end, it all depends on your cost of capital, your cost of debt, your cost of equity, how do you amortize your debts and equity, and also what type of credit you are going after. If we speak about leasing in aviation or in shipping, you have to be careful about what credits you are going after. Most of the equity that you have behind either in aviation or shipping are credits that are focusing in infrastructure. So they have enough asset classes to go after. So you need to make sure that you are convincing those equity houses or that equity partners that either have a tax depreciation or it's an equity yielding strategy, why they should invest in shipping or in aviation or any other asset class. And we see more and more equity, especially the tax depreciation equity, asking for more shipping deals, looking at tier one names with a quick depreciation of the ships that can give them advantage on tax depreciation. A little bit similar to what used to be in the German markets before with the German KG. We see now that's very present in JOLCO markets in Japan with a big need for quick depreciation.
Now, stepping back to the senior bank debt, in the earlier panel, there was mention of Basel and its impact on banks' abilities and to assess credits. So how is the current regulatory environment impacting the way you analyze credits at your bank right now, Evan, and going forward? Yeah.
You have two American banks on this panel, so that's an interesting
I know,
question.
that's why. Yeah.
Also privately controlled, so that's
Right.
interesting. Yeah, the working in a bank and having the regulations is nothing new. So you're asking, looking forward, it doesn't cause any terrible concern. That's just part of the cost of doing business. That's part of what our stakeholders or shareholders require. And if you can get past, if you can be successful in a system where now we have more sanctions and more compliance and more KYC, and as soon as you get that process down efficiently, I'm pretty sure we can handle the other regulations.
Andy, do you think banks such as yours and Evan's domestic banks sort of have an opportunity or an advantage to maybe other international banks in this environment?
Absolutely. I think the Europeans are ahead of the curve here, and it's to their detriment because, I think that we all know that they're probably, from a regulatory perspective, grossly undercharging for their capital. We don't have to worry about that, but we do worry about it because we charge more for our capital anyway. We happen to be very well capitalized anyway, so we don't lose sleep over this. We've got a balance sheet of about $25 billion with about $5 billion of capital, so puts us in one of the top tier of capitalization structures in the US anyway. So look, we don't lose sleep about it. Regulation, obviously, at some stage will cross the Atlantic in a more stringent way. And, we'll cross that bridge when we come to it. But, I think that what we've done in the past is shown that we provide, to our shareholder at least, an adequate return on capital for the risk. And, where I live from a pricing perspective on an average basis is about 600 basis points over funding cost, which I think is a decent risk reward for at least the deals that we've done in the past.
Interesting. Harris, I can ask you, so we're talking about bank debt and we're talking about leasing structures. When you're putting together a deal, are they mutually exclusive? Do you look to bank debt on the back end? Is that something important to you?
Well, we decided to set Neptune Leasing up as a company rather than a fund, as I said earlier. And the reason we did this is that we see the relationship with the banking community as symbiotic. First of all, we offer to some banking partners the ability to do deals that they wouldn't have been able to do otherwise, for example, because of geographic restrictions they may have. And number two, we give the ability to our clients to get the benefit of our conditions versus what the bank market, would have been able to provide. So all in all, we're working very well together with the banking community. We don't necessarily see ourselves competing with them. We see ourselves working with them, and that's been proven to be very beneficial for us, for themselves, and our clients.
Evan, do you experience that as well? I saw you looking.
Because I can't hear with this sound system, so give me the 10-second recap. I'll tell you whether I agree or not.
Well, we work together with banks because we see the relationship as symbiotic.
Yes.
And you have been our first bank, so...
Yes, thank you.
So it's that and buying portfolios.
Yes. No, it's a very symbiotic relationship. So we work with Aris and other funds happily.
So, we have to talk about it. Every panel is going to talk about it. Decarbonization. I'm not talking about financing decarbonization, but how important, and I'd like to hear from each of you, is a company's decarbonization strategy or plan when you're assessing a credit? How much do you weigh that as a factor? Maybe Andy, if we can start with you.
Roughly 0%. Again, we're a little bit contrarian. So for us, we see opportunities where the traditional banks are shying away from deals that, tend not to fall in compliance with the latest guidelines on ESG, whatever they may be. In fact, we'd probably classify ourselves as the anti-Poseidon here, in that, if they don't want to do the deals to those companies, we're more than happy to step up and do the deals, because that's where we thrive. We thrive in atmospheres where other lenders are walking away. Classic example of that, our fossil fuel business back at the office in Dallas, it's been abundant in the last couple of years. We've done about $2 billion in fossil fuel and fossil fuel adjacent businesses. On the shipping side, on the marine side, I've done about $500 million in the last 6 months on oil and gas adjacent industries. And the simple reason for that is that lenders are shying away from it for one reason or another, and it's leaving a vacuum, and somebody has to step in, and we're happy to do it. Well,
you're anti-Poseidon, but pro-Neptune, I suppose. So that's we looked at it from the point of view of transition. So, because we're not going to get from A to Z overnight, this is going to be a multi-year transition period, and we cannot allow the shipping industry to be, unfunded, basically. And that's the premise of, our business. So we continue to fund the shipping industry. Of course, we're happy, and we have been funding new buildings, eco-friendly vessels and everything else. But also, we don't shy away from doing older ships, with a particular emphasis in helping owners to increase the efficiency or do the upgrades and the rectifications on the vessels that will allow them to meet new regulations, CXI, CII, etc. And this has been a successful strategy because, for them as well, because the price differential between, ships that are non-eco to those that are eco engines is pretty significant. So actually, in fact, as an owner, if you're able to buy a non-eco ship, upgrade it, and have the same charter rate that an eco ship makes, then you have a winning strategy. So that's number one. And number two, at COP28, the world decided to decarbonize. Whether you like it in Houston or not, that's a different story. But by tripling the amount of renewable energy and tripling the amount of nuclear energy. So, and somehow we need to be able to convert the green electrons to green molecules. And I think this is where the transition is coming back again, because we're going to need a lot of those new technologies, new ships that are going to allow us to actually transport these green molecules to where they need to be transported. And of course, we're happy to help in this fashion as well.
Ali, where do you see a company's decarbonization strategy impacting its ability to find and seek financing opportunities?
We're financiers, and when you finance aircraft, ships, you have more and more equity houses, banks that ask you what is the impacts of carbon on aircraft or on a ship. So it's extremely important. It depends if you are going to raise money either on the debt side or the equity side, that you are very careful about that and that you have a strategy about that. And we see it's more and more present, especially in Asia, like in Japan and in the Middle East, where this is becoming a big part of the question when you are raising money. It's what will be the impacts on carbonization and what will be the impacts on ESG. So if you want, it depends. If you're financing 100% yourself, of course, it's easy. But if you're going to raise capital, I think there's a big need to have a strategy for ESG and the strategy for carbonization. We saw it in aircraft leasing, which was a big impact. And if you look at aircraft, it's only about 2% of the impacts worldwide of the carbon from aircrafts. But it's still huge when we raise money of what is the strategy for ESG. I think it will be the same in shipping. When you're going to try to raise money, and we see it right now when we're raising money for this strategy we're doing, it's a big ask. What is the ESG impacts? How are we going to manage it? And we are going to see it more and more in the next few years.
But I just need to add something to what you just said, of course, correct. But also we moved away from only looking at the quality and how green the energy is and the transition to also looking at security. And this is why, for example, the European Union, where initially natural gas and LNG were not part of the green mix, but then eventually the realization came in that we need to be able to, go through this transition. So LNG and natural gas is part of what is considered now, a path to the transition to a greener future. And I'm happy to say that even here in the US, I read the other day that there's now technologies being developed that even make electricity production from natural gas much greener than it was originally. So I think the combination of capital deployment and technology is going to allow us to go through this effectively. I'm very optimistic about it.
Yeah, so mindful that we're not getting from A to Z overnight, but Evan, in your analysis, how critical is a company's decarb strategy when you're looking at a deal?
What's really critical is that our clients, our ship owners, are compliant and they're competitive. So to stay compliant, they have to abide by all the rules. So they're going to have certain emission requirements and standards. To be competitive, they have to attract the charterers and the business and the cash flow that we, largely speaking, as citizens of the planet, are going to require. So long as our clients have the ships, they're newer ships and better technology, and they're going to earn the cash flow to repay our capital, we're good.
Thank you. Now, mindful that we're about to run up on our time, I'd open the floor for a question or two, or a last word. And seeing none, I will thank our hosts at Marine Money, and thank you for your time.